Chirag, I think you have my slide of questions. And
Yes.
so, of course, we know that India is one of the fastest now. And with the current situation, of course, India has underperformed. And now our valuations have also corrected. Now, going forward, what's your outlook? Now, people are talking about global investing, Indian investing. And I know you are an Indian manager, one of the finest in the small and mid cap space. How do you suggest people to position their portfolio going forward, looking at the growth differentials between India and America and the rest of the world?
Sure. So first of all, Abhishek, thank you for giving us the opportunity to address your audience. Let me quickly highlight uh, a bit of a background in terms of where we're coming from to get a perspective on where we are today. We have seen a correction of almost 20% from the top in small cap, roughly 15 or 10-15% from the top in mid cap. And we've also seen a time correction of roughly a year and a half. So it's been a combination of a time correction of a year and a half and a price correction of 10 to 20%. We obviously saw a very sharp rally prior to this 2 year period. We saw extremely sharp rally in mid cap and small cap. Post that sharp rally, mid cap and small caps were trading at a premium of 40 to 50%. And hence, almost 2 years ago, we became very concerned on the valuations on that segment, and hence we advocated to investors to be cautious. Post this correction, so a time correction of a year and a half, if you assume that portfolio earnings growth is roughly 15%, that translates into a roughly 20% correction in valuations from a time correction standpoint. In addition, as I mentioned, there's been a 10 to 20% price correction. So you add the time and the price correction, that's roughly 30 to 40% correction in valuations, which has taken place. As a result, post that correction, what used to be a 40-50% premium has now come down to a marginal premium compared to its long-term average. So when you look at the market today, the Nifty is trading at close to its long-term average. Mid cap is trading at a marginal premium, and small cap is still at a little bit more of a premium to that. So compared to 2 years ago, when we were concerned in the market and extremely cautious, we are now at a position where we are much more neutral in our expectation. We don't think valuations will necessarily move up or down over an extended time frame, but certainly we can capture at least earnings growth. And hence we are a little bit more positive on the market today compared to the past. Having said that, we are not thumping the table by any means because the market is not cheap. We have gone from a market which is expensive to a market which is now reasonable to a little bit expensive. And of course, within the overall market, while indices have corrected 10-20%, individual stocks have corrected far greater than that. And I think that is the opportunity at a stock specific level. We are able to identify stocks which have corrected 40-50% and thereabouts, and in some cases even more. And individual opportunities have certainly started presenting themselves. So again, from being in a negative frame of mind for the last 2 years, we are now in a neutral frame of mind as far as small and mid caps go. Large caps, we were more constructive in the past. And we continue to remain constructive on large cap, but relative to large cap, mid cap and small cap, which was an area of concern, is now an area where we are somewhat neutral. And what we are advocating to investors is that, as opposed to the past when we suggested that one should stay away from SMID entirely, now is the time one can start allocating and do it in a systematic fashion and do lump sums largely on corrections. And the reason we are now suggesting that we can invest on corrections and we didn't in the past is, in the past it was expensive. So when you correct from expensive, you remain expensive. When you correct from reasonable, you get into cheapness.